Hi, my name is Paige Lohuis, and I am the Marketing and Events Manager for SFOX, and we're excited to welcome you to our AMA session. We have prepared an insider's perspective on how post-trade analytics can inform your crypto strategies and performance. Dimitry, it's great to have you here today. Can you tell us a little bit about your role here at SFOX?
Absolutely. Thanks for the invite, Paige. Really excited to share this report that I've been working on, and talk about the overall value that it delivers to our clients. So my position at SFox is Client Success Manager. A little bit about my background: I spent over 10 years in the financial markets and working for different fintech companies. Started with FXCM, FX brokerage, where I really learned kind of like the execution side of things and liquidity in FX markets, and then jumped into crypto, which is quite different when it comes to liquidity. It's not as big as FX, which puts more emphasis on the execution quality and all these type of things. So yeah, that's my background and role.
Great. We want to remind everyone that we will have time for questions from the audience throughout the webinar, so please feel free to submit any questions you might have in the Q&A box, and we'll do our best to get them answered. And with that, Dimitry, I'll kick it over to you to teach us all about SFox's trading insights.
Awesome. Sounds good. Thanks, Paige. So I'm going to share my screen for this presentation, and then we'll kick things off. All right. So before we kick in, discussing this report in general, I want to make sure that you guys understand like the overall goal of this, right? So as a client success manager, my position is to make sure that clients come to SFox and can achieve their trading goals. Well, a huge part of that being a liquidity venue is making sure that we have that liquidity and we have that execution quality, and clients know how to use those tools to achieve their trading goals. So this execution report is designed specifically for that. This is what we offer to our institutional clients. As being a prime brokerage in space, you get an exclusive insight report that can help you understand your execution that we see from our side, and how you can improve essentially that to essentially minimize your slippage, which essentially is another thing that is considered to be a cost of trading on top of fees, as well as how to optimize your strategy to achieve the results that you really want. And it really is geared towards different types of clients. Even if you're an HFT desk that is focusing, let's say, on execution quality, or the price sensitivity is high for those clients, and maybe their speed sensitivity is high as well. There are tools that we have here to basically help them achieve the results that they're looking for, as well as just regular hedge funds or individual traders that are conscious about the execution. This report can help them understand how to better interact with our environment and achieve the results that they're looking to achieve. Because at the end of the day, you have your strategies, and the last thing you want to do is get hung up on extra costs when it comes to executing the strategy. And this report essentially provides you insights on where you can improve on that. Specifically, in this report, you will see data. So I've used this, it's an example report. As you can see, XYZ Capital, I've just used that as a sample. It's not an actual clients data that I'm displaying here, but there will be parts of this report that will have real figures there when it comes to liquidity on SFox platform for different pairs. So in this report, we will take a look at the sample of metrics from this institutional client that performed trades, and then we will benchmark that against the top 15 institutional clients that are trading the same pair and using the same order sizes. And this way we can compare if this XYZ capital is essentially performing better or worse against other unaffiliated participants on the platform. And from that, we can derive data-driven results that can lead us to certain suggestions and improvements that we'll cover. So anyway, that's kind of the intro about the actual report. Let's kind of jump into it. Table of contents, we'll kick off with that. High-level metrics, execution metrics, average liquidity versus average order size, and then overall performance. This is where we're going to summarize the benchmarks, how this particular sample client is benchmarking against the top 15 in terms of the execution quality, and then opportunities to improve. So let's kick it off. High-level metrics. So this is something the clients will get. You can see the data range, total volume traded, top traded pairs. This is something we'll put together to identify which are the most popular trades. Top used order type is TWAP for this client, time weighted average price. And then you can see the order fill rate that they're getting on that is almost 100%. And then on the right side, we have the average order sizes for this particular client on BTC and ETH, as well as maximum and minimum slippage. So yeah, it's important to keep in mind also when we see negative slippage, that means that the client is actually getting a better price than what is available in the market time when they sent that order in. And just in general, slippage is basically it's measured in basis points here. Is that once you send an order in, by the time the order gets in, how far from the market price are you getting filled? Are you getting that best price, basically at the top of the book, or are you getting slipped and you're losing a little bit on the best price, which essentially becomes cost to you? So this is why it's important to measure slippage, is to essentially want to minimize slippage as much as possible, or even put it in a negative side, which means that you're getting a better price than you originally saw when you sent an order in. So that's just the high level, and now we're getting into some of the kind of like the meat of the report. So here we're looking at execution metrics, slippage, BBO, meaning best bid offer. So we're measuring slippage based on top of the book, meaning you have the best bid, you have the best offer, and let's say you send your order in, how far from that best bid and offer did you get filled on your order? And essentially there could be multiple causes of that slippage. It could be the fact that maybe the market conditions are changing. Maybe your order sizes are so big that it's impacting the liquidity at that best bid and offer, which is causing slippage. Or maybe your orders, again, are so big that it's indicating to the market participants that there's someone big is looking to build a position, and therefore they're starting to price certain quotes higher. So measuring slippage from BBO, in my opinion, is the best way, but that's not the only way. We'll get into that in a second. As you can see, the chart here on the left is showing this XYZ capital, BTC and ETH slippage in basis points, and this is positive, meaning that on average they're experiencing slippage that is 2.02 on BTC and 3.45 on ETH. And again, positive slippage means that this is an extra cost that this client is experiencing on top of the trading fees. So when they're sending orders in, they see the best price, but by the time they're filled, they're off by X amount of basis points, which is essentially they get a worse price than what was available in the market when they sent the order in. And then we look at the benchmark, which is the top 15. And the benchmark is showing that BTC actually, on average, during the same time period that we've sampled this data for a client, they on average people were actually getting better price when they were executing their orders, negative slippage, price improvements, and order fill is much better as well. So this right away indicates to me that this is something that the client needs to take a look at and see how they're executing their orders or what kind of order sizes they're using, because as you can see, the benchmark is performing much better than what they're doing. And it's also important to understand that every client is different. Every strategy that they use is different as well. Some clients can be more price sensitive, where slippage is something that is ultimately very, very important for them. And maybe they're not as time sensitive in terms of like how quickly they want to execute an order. And some other clients actually are more time sensitive, meaning that they want to get into the market on a breakout, let's say, in a fast moving market. And for them, they're not that price sensitive because they are actually care more about getting the fill of their order full size. And it doesn't matter, the few basis points that they lose is not really something that they'll be concerned about, which is fine. And there's those that actually want to just optimize it and have it, have it kind of in the middle, where it's like, I'm a little bit, price sensitive, I'm a little bit time sensitive, and there's a balance there. And those are kind of the three type of clients that we usually deal with. And this report helps us identify where they are now and how we can lead them towards like the most balanced situation when they interact with our liquidity menu. The next one here is same thing, but it's measuring slippage from a midpoint. So this is something that some institutional clients do, where instead of measuring slippage from the best bid offer, they calculate the midpoint price. So they take it to best bid and offer, they calculate what is the middle price, and then from that middle price they calculate slippage. This is the reason why I've included this, and I include this in the report, is just in case the measurement for that client is used from midpoint, because sometimes their strategies are written to calculate it this way. And as you can see, they're underperforming because they're experiencing positive slippage on BTC and ETH, while the benchmarks are doing much, much better. And in my opinion, the average slippage from BBO is a bit better to use, because when you use the calculation from the midpoint, essentially you open up this other variable of spreads, meaning that if the spreads overall widen on the pair, then the midpoint price is going to be quite different there, because you're going to have to calculate the best bid offer that is wide, the midpoint price there, and then the slippage itself from there, which is naturally going to be quite elevated. So this is why I stick to the best bid, best offer when calculating slippage. But again, it's more of a preference for the client, and some clients do have strategies that are based on mid than BBO. So therefore, I've included the statistics as well. Okay, so yeah, I've been kind of talking here quite a bit. If we have any questions about anything that I've covered so far, please share.
Yes. So based on this slide, how customizable is this data?
Great question. Yeah. So this is just a simple report. It's a foundation report. This is very customizable. And typically when I have a conversation with the client before I generate this report, I dig deep into what is important for them, figure out what is their strategy, where do they fall in that spectrum in terms of sensitivity when it comes to time and price. And based on that, I tailor this a bit, based on their requests. So, for example, what I can include average weighted averages. So meaning that let's say a weighted average for slippage would be based on the average order size. we had some of the clients request that because it gives them a bit more of a full picture there, because they're using average order size, this big, and then what is the slippage weighed based on that size, which helps them identify, okay, is it maybe the size of the orders that I'm using that are too big, that it's weighing too much on my price, or making my price worse, or is it something else? So I've done that for a client as well, where we used average that is weighted against the trade size. And we also do have that over time as well. So basically, we develop a chart for a client where we look at that weighted average of slippage from BBO and mid over time, month over month, so we can see overall, which month they might have experienced higher slippage and which month they experienced lower slippage. And in general, this is something that I do as well with clients after we have a session of discussing this post-trade analysis and this execution report and recommendations. We will have another session where we'll pull the data again, and then we'll take a look and see, are we moving in the right direction when it comes to helping that client achieve those trading goals that they're looking to achieve.
Great, thanks.
Awesome. Okay, so if there are no other questions, we'll continue. So this is a very important slide here. Obviously, everything comes down to liquidity and kind of like the order sizes. So the metrics that you guys see here. So as a liquidity venue, we work with something around like 30 different liquidity venues, and split between OTC desks, exchanges, and so on. And what this chart is showing here, and this is just for visual purposes, the main part here are the actual numbers, and these are real numbers in terms of the last 30 days. This is the snapshot of average standing liquidity, and we're looking at around 300K on this is for BTC, 300K at best bid and offer. On average, this is the standing liquidity. And then if we pull out a little bit more, meaning that what are the next 5 bids and next 5 offers down, from BBO, these are the type of figures that we have on average of standing liquidity, meaning that, this is the standing liquidity that you can execute against when you send your orders in. So the first part shows you how much is it, at top of the book, and the second part shows you kind of what is the depth, right? If you're looking to execute a number that is higher than the best bid or offer, well, what are the other orders outstanding that are beyond the best bid and offer that you can get fills on, and this is a representation of that. Now looking at our XYZ Capital client here, you can see that there are average order sizes for BTC buys and sells. We'll break that up just to see how they're interacting with the liquidity there. It's also important to keep in mind, this is the average standing liquidity, but you have to take a little bit of a grain of salt when you look at average order size, because the moments when this liquidity obviously changes due to market conditions, and maybe the client does most of the execution during very volatile market conditions, where liquidity might not be exactly this, but it gives you an idea on average. This is kind of what the liquidity is, and we can understand the average order size, and we can then try to dig deeper and see where we can improve on the order sizing or order types that clients can use to be closer to that benchmark that we're using, which is the top 15 clients that are using a kind of similar strategy, or using the similar order types and the same pairs that they're trading on. So right here we can see that on BTC the average buy is about 78K. The average sell is 85 based on average liquidity. That's not bad. But the important point here is that from the benchmark, most of those top clients, they actually have orders that are sized down. And my kind of expectation here is that most likely this is why they're getting a better price, is because they're trimming down orders. Perhaps maybe the reason why they're getting a bit more slippage is because once they start executing those orders that are higher in terms of like the average, then they're causing some of the liquidity providers or market makers to start reacting to those orders because they're seeing that flow coming in, these bigger blocks, and therefore it's causing some of the slippage for the client, and they're getting a little bit worse price than what was available in the market. While the benchmark has smaller average order sizes, which doesn't maybe necessarily signal to the market that there's going to be a big block coming through, and they slowly are able to scale in or scale into position faster at a better price, as you can see that by the benchmark. So that's for BTC, and then this is for ETH. As you can see, ETH has a little bit less liquidity than BTC naturally. Again, this is we have the same amount of liquidity providers there and OTC desks that you'll have access to. But in this case, it looks like the client is experiencing higher slippage, but also we're seeing that they're using much higher order sizes. So for example, the red flag right here right away is that client is firing off on average about 189K in terms of like order sizes. And we can see the average standing liquidity at BBO is lower. So we can expect that there will be some slippage and worse price that the client will be getting, just naturally because their average order sizes are higher than what the OTC desks and exchanges might be quoting there at those prices. So that means that, let's say for the sell order, it'll start tapping to next levels. These top 5 bids, it's going to start getting into the levels that are a little bit further from the best bid, therefore causing slippage and therefore causing extra cost at the end of the day for that client because they're not getting that best price in the market. And then meanwhile, benchmark, as you can see there, their average order sizes are much smaller, and therefore you can see that they're getting much better in terms of the quality of execution, and their price at the end of the day is better in terms of slippage, and therefore brings down their cost of trading. And this is the slide that kind of summarizes everything for the client to see how they're performing. As you can see, like what we just covered, the average order sizes, above average. It's in yellow. It's something just to take a look at and see if it needs to be addressed, because it doesn't necessarily mean that you can't execute these, let's say order sizes. You just have to execute them in the right way to minimize some of the slippage to improve the quality of your execution. For example, we're using TWAP, time weighted average price, which essentially what it does, it slices orders up based on time and sends them off to the market. For example, if I'm doing TWAP sell on BTC, that means I'm, let's say, selling, in this case, 78K on average, and every, let's say, 50 seconds in those type of increments, and you can customize that. Well, here, we obviously see that they're using TWAP with much higher sizes. Maybe they could slice them down a little bit and maybe adjust the overall increments. Maybe their duration of the TWAP is longer or shorter based on these type of sizes. Where we see on the benchmark side, we can see that those clients that experience much better execution in terms of slippage, they've used smaller average size to get into those positions. So like, let's say even if you want to get into $1 million position or $10 million position, you can certainly do that, and you can still preserve the quality of the execution. All you have to do is just use the right tools to do that, and configure them in the right way in order to not signal to the market, for example, that you're looking to buy or sell $1 million or $10 million worth of this asset, because we know how the market works. Once someone finds out, suddenly the prices start to tickling up, especially if you're trying to buy, because everybody is looking to sell and make profit at a higher price. So that's what essentially causes the market impact, the slippage for some of these clients that are might not optimize their strategy to the best ability to interact with our liquidity venue. And this is the goal of the report, is to make sure that we optimize their strategy to interact with our liquidity venue in the best way, so they can achieve those results, minimize the costs, because at the end of the day, if the client is happy with the execution, with the cost, and then they're going to continue to trade, and we're going to be happy, and it's a win-win type of situation. So again, the average trade sizes, they're above average, which is not really that good. And then looking at the slippage, everything is below average, as we already covered. So benchmark is essentially winning across the board when it comes to slippage on ETH and BTC. And as far as the order fill rate goes, they're not far off. So I wouldn't say that's a really too much big of a deal to focus on for this specific client when we're analyzing their execution. So then we, lastly, we look at opportunities to improve. And these are some of the suggestions. Obviously the client is using the TWAP, this algo that we have available for clients that are trading through UI and API. And we have these algos available to all of our clients, so they can take advantage of that. We're probably one of the venues that offers this, a basket of these strategies that we put together of algos that you can take advantage of. So like I said, TWAP is, basically slices your orders in smaller sizes and executes them based on certain increments. And then, the use case is when you want to execute a large order at an average price, but you don't want to impact the market, or you want to minimize the slippage when entering or exiting position. So the client is already using TWAP. What I would recommend in this case is lowering the average sizes of slices and maybe taking a look of what the frequency is in terms of that TWAP executing. Well, what increments are they using? Is it every 5 seconds? Is it every 10 seconds? And so on. And then, recommend them making the adjustments there to, improve their overall execution and minimize that slippage cost that they're experiencing, which is higher than, the benchmark. The other order type that I would recommend here, and this one is a bit, more aggressive than TWAP, and this is something that if they do want to, emphasize kind of like the order fill percentage, meaning that like you need to get into the market and you're trading during certain times when there's quite a bit of volatility. Sniper is something that can be used. It routes IOC orders to liquidity providers, and essentially it's taking the maker prices that are better than or equal to the limit price of the order. So it's kind of like TWAP, but it's more aggressive. It's constantly firing off, and it's taking the best price available based on the limit that you've set there. So again, aggressive taker whenever there are bids and offers available better than or equal to the order limit size, while hiding the full quantity of the order in the dark pool to mitigate any market signaling potential matches there. So that's also a very important point, where if you are executing in a bigger size, you want to be conscious of signaling to the market and making a market impact. Like I mentioned earlier, once somebody finds out you're looking to buy a big stack, those prices might start reflecting that, right? They might be trading and they might be requoting at a premium, and that's where the slippage is coming through there. So those are the two initial thoughts in terms of this sample report for the sample client that I would recommend. And this obviously varies across multiple clients, and as I said earlier, based on the question that you asked, Paige, is that it's very customizable. So we tailored these reports based on what the client is, or like what their strategy is, and what they're looking to accomplish, what is important for them. I know I've been kind of talking here a lot. Are there any questions that came up?
Yeah. What would you recommend for a client who is focused more on order fill percentage and speed of execution rather than the quality of execution?
I'd say, yeah, that's a really good question. So actually, let me take a look. Yeah, I do have a slide on this as well. And this chart right here pretty much outlines our order types, which is the algo types that are most popular. There are more of them, but these are the popular ones. And you said that somebody who is, looking, who doesn't really care that much about the price, but cares about the speed, right? So meaning that, market orders, or market fill or kill, those are the ones that come to mind right away. And we know the market orders, they're basically guaranteeing execution, but not price. So therefore, if you're looking to get into the market quickly, those two order types would be something that that I would recommend to the client to use if they're not price sensitive, meaning that they should be expecting, there will be slippage there, but based on their strategy, they don't really put emphasis on that because, their trade would outperform and cover that slippage and extra cost. So basically, they're paying more because their strategy is profitable because they exercise that strategy during the time, when volatility is high, and when they experience slippage. So their slippage and the extra cost of trading is actually baked into their strategy, so they understand that, and therefore they care for, I just want to get in and out, quickly, and therefore those are the two type of orders. Now, if they wanted to maybe balance it out a little bit, this is where they can get into sniper, and that's what I covered earlier. A TWAP taker, that could be, a time weighted average price algo that, let's say, would buy or sell every 2 seconds. Therefore, it's quick and executing those orders, and tries to kind of minimize that slippage while prioritizing speed. So unlike the market orders, these type of orders try to balance it out a little bit, where you're getting the speed, but you're also not fully compromising in terms of slippage that you would be receiving from executing your orders. And also, like I said, again, if you are executing big orders, using the market order also will probably have quite a bit of impact because you signal into the market, right? So if you're using bigger orders, it will be highly recommended to use a TWAP or a sniper in that case. So therefore, you can not signal to the market necessarily that you are looking to execute this full size at whatever price that you can get. So, and then there's also more balanced, right? So the most balanced algos would be smart order routing, which is smart order routing is something that we have by default as liquidity aggregator. And what it does is basically routes to the best available price. So meaning that we have the order book from different liquidity venues, OTC desks, and the smart order finds the best price and then sends out your order there to get that fill. And it is kind of the most balanced order type that you can use based on price sensitivity and time sensitivity when it comes to executing your orders. And then when really you are not looking to when you're not really time sensitive, what you can do is you can use something like TWAP post only or Gorilla algo, and you can basically post your orders at the top of the book and wait for someone to fill them. Now, this means that you're very price sensitive. You're really looking for like specific price, and that's where you probably gonna get quite a bit of that negative slippage or like price improvements and so on. But you're compromising on order fill percentage, meaning that it is possible that you might not get your full order filled, maybe in in the time that you wanted to get filled, or maybe if time doesn't really matter, then you're gonna have to wait for that to get filled fully. So compromising on that side, but you're really focusing on price sensitivity there. And there's the others there in between. As you can see, TWAP is kind of used across the board. There's two types, right? There's the post only and there's the taker one. The post only one is the one that actually just posts orders. It doesn't take, and that's the one that's more price sensitive. But the reason why it's across the board is because TWAP itself is configured like what increments you use to fire off those orders. So meaning that if you're looking for time sensitivity TWAP taker, then that's where it's like, all right, fire off orders every second, every 2, 3, 4 seconds. In those increments, you're gonna continuously fire off sell or buy orders that will take from those liquidity, take from liquidity. And then same thing on the TWAP, but if you're want to be on a low sensitivity side for TWAP taker, then let's say I want to fire off every 5 minutes those orders, and engage in that behavior there. So that's kind of the order optimization chart, and hopefully that helps you guys kind of understand some of the algos that we have. This is not the full list of them, but again, these are the most popular ones that we have. And if you guys want to learn more about the algos and kind of find out what's available, you can go to the platform Pro Trader tab, and you can take a look there. There's each description there, for each order type that you have access to. And again, this is available through UI and it's available through API. So you don't have to code strategies yourself. You can use some of these strategies that are already available. This is something that you should get exclusively by being a client of SFox. And yeah, hopefully you guys enjoyed this presentation, because I think that was the last slide.
Great. Another question for you. What's the difference between aux and dark pools, and what situation should a client be using each of those?
That's a great question. So, aux is an internal order book. So we have external order books, which is OTC providers, and we have exchanges that are streaming prices in the order book. Now, we also have an internal book, meaning that as a client, I can actually post my order on SFox and be matched with, let's say, if I'm looking to sell BTC and I post my order to sell on aux, I can be matched with someone at SFox that wants to buy BTC. And we don't have to go externally to an exchange or OTC providers. We just simply match, or we partially match that client. Let's say you want to execute your order. We'll first check, let's say, what is internally available, and then fill that part of there if the price is better, and then we'll send maybe the rest to externally to optimize that overall execution. But aux is an internal book. Just think of it like as an exchange that has orders that clients just place there, and we match those orders. Now, dark pool is very interesting because unlike the aux book, which is it's a lit book where you can see all the orders as a market participant, you can see it on the platform. Here are the orders. The dark pool hides all the orders, meaning that you can post orders, but they're not visible to anyone. And why is that important? Well, this is again comes down to signaling to the market, right? So if you are, if you're looking to execute, let's say, a TWAP post only, and you're looking to move size, so you don't want to indicate to the market, let's say that you suddenly have a sell order of 10 million on BTC at the top of the book, and then everyone is just gonna signal to the market the fact that, hey, there is a big seller that's looking to sell, and therefore the market will react and prices will start fluctuating, and you might not get best execution there. So what this offers, this feature offers, is to hide your orders from the market, but also participate in the market, meaning that let's say an order comes in from a client to buy BTC, and in a dark pool, even though that price is not visible to anyone, there's an order with the price from a client that gets filled, and then so on. Let's say the Ox or the others venues will get filled if there was not enough in the dark pool. But dark pool feature is great because it gives you the ability to hide those orders. Actually, in fact, Sniper uses that strategy because it doesn't show the full size, and it keeps the rest of the size in the dark pool while executing, which is a nice feature that you can have. You basically combining a feature where you have the lit book, and then you have the rest in the dark pool that you can hide and not affect the market's kind of sentiment as you're looking to execute.
Great. Well, thank you, Dimitry, for giving us clarity on trading patterns that will definitely help clients with their strategies based on the analytics you showed today. As we come to the end of this webinar, I have one last question I want to ask you. What is next for SFox's order book?
Yeah, absolutely. That's a great question. So this is another purpose of this report, is also because we have interactions with clients. We're constantly analyzing our execution, constantly analyzing our liquidity, and the participants that are interacting with this liquidity. And that's, we have to do our part to create the environment that is good for these clients to be able to operate in. So part of this report is also for us to hear feedback and look at statistics constantly and evaluate our liquidity and how the participants are interacting with this liquidity. So the big things that we're doing in terms of improving the liquidity on our side is we're going to be building out quite a bit for the Ox book, and we're constantly getting more liquidity venues that we're adding to our stash, which the more liquidity we have, the more you can execute against that liquidity and not experience let's say slippage, and have more like price improvements and more competitive access to the pricing there. So this is something that we're focusing on right now, and throughout these reports and internal reports of analyzing liquidity, we're continuously overall improving that experience for those clients that come to trade at SFox and interact with aggregated liquidity venue like us.
Great. Well, thank you for your time today. This has been very informative. Also, thank you to everyone who attended. We hope you learned something new about SFox. If you're an existing client that would like to gain a clearer view of your trading platforms and data, make sure to schedule some time with Dimitry to review. And if you're looking to onboard with SFox, please reach out to schedule a demo where Dimitry can chat with you about how to confidently navigate your trades. Keep an eye on your inbox or check out our YouTube channel for today's recorded episode. We will be running this AMA series every month on different topics, so we look forward to seeing you all soon. If you have any follow-up questions that we didn't get to, please reach out to the SFox team to learn more. Bye, everyone.